All right, let's dive into a classic puzzle for any investor. We're talking about the industrial giant Siemens India. Now, pretty much everyone agrees it's a fantastic, high-quality company. No debate there. But here's the real question, the one that actually matters for your money. Is the stock at its sky-high price a smart buy right now?
Well, the thing is, there's no simple yes or no answer here. It really, and I mean really, depends on what kind of investor you are. Are you someone who's in it for the long haul, focusing on quality? Or are you maybe looking for a quicker opportunity where the price is everything? So we're going to look at Siemens through two totally different sets of eyes today. On one hand, we have the long-term believer. This is someone who cares about top-notch quality and ethical standards, like whether a stock is Shariah-compliant. On the other hand, we have the short-term trader, who is just laser-focused on that price tag and wants to see gains sooner rather than later. Let's see how Siemens looks from both angles.
Okay, first up, let's build the case for buying Siemens. And trust me, it's a strong one. This company is basically the definition of a blue-chip industrial powerhouse. And the numbers? They really do speak for themselves.
Let's start with a really important metric, return on equity, or ROE. Siemens consistently pulls in somewhere between 18 and 19%. So what does that actually mean? Well, it's a measure of how good a company is at using your money to make more money. And numbers like these show Siemens is incredibly efficient. That is a huge green flag for quality.
And the efficiency story just keeps getting better when you look at another metric, return on capital employed, or ROCE. This one sits at a really powerful 22 to 26%. This tells us that the entire business, not just the money from shareholders, is just a well-oiled profit-making machine.
And here's another huge plus, especially if you're a long-term investor. The company's financial health is rock solid. Siemens is effectively debt-free. That means it can handle economic downturns way better than its competitors who are loaded with debt. It just seriously cuts down the risk. Now, for our long-term believer, and really anyone focused on ethical investing, this is the clincher. Siemens gets a crystal-clear pass on Sharia compliance. It's classified as halal by screening services like Musaffa, and it's a major holding in ethical funds. So yeah, from a quality and compliance perspective, it is checking all the right boxes.
But, and you knew there was a but coming, as strong as that case is, we have to look at the other side of the coin. Because despite all this good news, there are some pretty serious red flags waving when you look at that price tag.
You're probably thinking it, so let's just say it. What's the catch? The company sounds great, so what's the problem? Well, the problem, in a single word, is valuation.
Just look at these numbers. Siemens trades at a price-to-earnings ratio of somewhere between 54 and 66. Its price-to-book is over 7. When you put that next to its peers in the industrial sector, these numbers are way, way up there. You are paying a massive premium for all that quality we just talked about.
And the story gets even more complicated. You see, a big chunk of its recent profits came from something called other income. And that's money that didn't come from its main business. So here's the crucial point. Its profits might actually look a lot stronger than they really are underneath. So what exactly is this other income? The easiest way to think about it is like a one-time bonus. You know, like selling off an old factory or a piece of land. It's great to get that cash for sure, but you can't count on it happening again next year. And when that one-off income vanishes, that impressive profit growth can slow down in a hurry.
Okay, let's just quickly summarize the case against Siemens. You've got that really rich valuation. You've got sales growth that's, well, it's okay, but it's not exactly setting the world on fire. You've got profits that have been puffed up by these one-time gains, and on top of all that, a tiny dividend yield. For a short-term trader, these are all major warning signs.
All right, we've seen the good, we've seen the bad. Now it's time to bring it all together and figure out what this actually means for you, based on your own personal investing style.
So let's get really practical. How do you take all this information and make a smart call for your own portfolio? Because remember, it's not just about whether the stock is good or bad. It's about how it fits with your goals.
Before you even think about hitting that buy button, run through this quick checklist. First, look at the current price. How does it stack up against analyst targets, which are hanging around that 3450 rupee mark? Is it way above? Second, glance at the chart. Does it look overbought and kind of risky, or has it pulled back to a safer support level? And finally, remember that its huge order book is great for the long term, but it's not going to turn into a giant pile of cash overnight.
Okay, we've laid out all the evidence.
The arguments are on the table. It is time to deliver the final verdict, and we'll do it for both of our investor types.
So, for our long-term believer, the verdict is cautiously optimistic. Look, Siemens is a fantastic, debt-free, Sharia-compliant company. It's a totally reasonable choice for your portfolio, but the key here is patience. Don't go chasing it at these high prices. Wait for the market to pull back a bit and buy it on the dips.
Now, for our short-term trader, the conclusion is a lot more black and white. Right now, the stock's profile just looks unattractive. The valuation is way too high, the growth is just moderate, and those recent profits are a bit misleading. There's just not enough margin of safety here for a short-term play.
And that leaves us with the big question. Is Siemens a cornerstone you can build a long-term portfolio around, or is it a high-price trap just waiting for an unsuspecting buyer? At the end of the day, the answer isn't in a spreadsheet. It's in knowing what kind of investor you are. Thanks for digging into this with us.